Okay, realities of investments is we're going to look at cost averaging, and it's used in a lot of things. And the reason I wanted to go over this is because people sometimes expect their money to be more than what it is, or sometimes even they're surprised that it's even as high as it is. But let's look at what's happens here. There's both dollar cost averaging and fixed dollar averaging. But right now, what we're going to look at, there's also a fixed percentage or fixed share. That has to do with the withdrawal. But for two plans to understand, you have dollar cost averaging. Okay, now here it is. It's the average price per purchase, and I have it both. I have it two times because I want people to look at what's happening here, and I also have it here. So the example is that Kenny, a friend of yours, bought a mutual fund for $100. And let's go over that right now. If you go on some websites, I do not have permission to give specific websites or names, but if you go on some, they'll let you start at $100. Some will. Some will only start you if you're at 1,000. If you're a general fund investor, if you're an institutional investor, sometimes they make you do 5,000. They'll give you a minimum of 3,000. Used to be they did 10, but lately they're doing a lot of threes and fives. So you need to look at which platform you're going to use. So anyway, Kenny bought the fund for $100. The fund has 28 pools of funds, and for right now, a lot of people will call this 28 units. Okay, or they'll call it shares for a better term, but it really isn't a share because it's not stock. Okay, but we can call it shares, and so I just put 28 pools of funds. The point is, you're going to have 28 units. Let's call it that. And it's not a real estate investment trust. It's just 28 pools of funds. I invested in a stock. For instance, this stock has both some mining stocks, like some of the pools of funds, they go and mine in a company. Franklin Mining, some of the Australian mining companies, some of the Canadian mining companies, and then they mine for specific things, and they will send you something called a prospectus, and or they'll email it to you, or they'll tell you that in your email it's available for you. And that prospectus generally tells you how they went about doing it, which companies they're investing in, why they think it will go up, and I emphasize the word think because none of us know what's going to happen. But so when you do this, these are for you to get a rate of return. Anyway, you have 100 shares, 28 units, and so when you divide that, you get $3.50 is your cost per share. Okay, simple enough. Okay, so average cost per share is here. Now, here's a situation. Dollar cost averaging method has both an advantage and a disadvantage. Your advantage is when the price goes higher, you contain the same amount of shares for less money at a lower price. So that's a good thing. So let's look at this, and I'm going to put a check here. That's a good thing that when you bought 30 shares, because the cost per dollar went down, it was $3.33. What affects that? What it costs the company to buy it, what's going on, how the general pools of funds that are together affected it, just like if you're buying stock. Here's the other situation: when the price is low, you may pay more for the same number of shares, you may pay less. Okay, so this could be here a disadvantage depending upon what the price is. And that's why when you're looking at them and they tell you, okay, this went down, and then they usually take a green arrow and they say, okay, price went up. Okay, you have to determine what you're going to do. And most times people say try to buy as low as possible. Okay, so when we move on, that same 30 shares at $105 gives you $3.50 for the cost of the same shares. See, this is what we're talking about. This is here the disadvantage. The price went up for the cost. You can think of this as like an acquisition cost. I'm not going to put that here, though I will put it and then erase it. Sorry. You can think about it as an acquisition cost because it's the cost to acquire it. And again, this depends on how the price has changed in the market, what it costs for the firm to get a hold of it. It depends on a lot of other factors, and you will go crazy if you try to sit and analyze each one unless you have all day to do it. Most people don't. So now it costs you $3.50, but look, it's still, what, 7 cents less than 28 shares. It's over here. So you're going to have to think about what it's worth for you and how much you want to cost it. And when you see all this writing in your portfolio, to actually look at what it means, because they send this to you. Now I have cut off where this fund, the name, comes from. Okay, and I want to look at what's happening. This is the current value as of Friday. Close of business was June 8th. So your obvious question to me is why did it cost me this? And then this is what it's worth. Well, and what's this negative going on? And you must be saying, what kind of idiot takes a negative, total cost? And that's a good question. So let me start here. In the first place, I withdrew money from this account. It was free. I had something and I wanted to take it to cover something else. So since it wasn't going to cost me anything, and since I only lost a little bit over here, I decided to take it. Now here's the other thing. Over the past 3 years, this particular mutual fund has not had a gain or loss. So you're asking me, why are you keeping it? Idiot, what's wrong with you? Because when I started doing this, people said you want to look at 10 years. And you, according to my father, some other people taught me some of these things, you have another 7 years to even watch what this does. Now, if this stays negative, I might try to sell it. I have the points that says redeem in your mutual fund cost. You can redeem. Or I might just hold on to it, but I need to look at this because if it keeps plummeting, that's a mess. And again, we'll get over into this. That's what happened. Anyway, cost per share is pretty high. It's $284.59. Number of investments. Okay, it equals here. This is your number of investments. Why is that 235? You have to pay the fund to manage it for you. Why are you paying the firm? Because I'm not a brokerage firm. Okay? And I'm going to go on ahead and put here shares. Put that in commas. Okay, I'm not the brokerage firm. So I can't, to be a brokerage firm, there's so much you have to do to even register. And to do this and dwindle around with money takes years of training and years of knowledge. So I let them, when you do 284, it's going to be a slanted 4, 59 minus 71 cents rounded. So 235.71. You're talking about this. Now this, stay tuned here, because this is the cost that you're paying the firm. So this would be 8. You would borrow here, and this would be 8. Right? Oh, wait a minute. Stop for a minute. We need to round up. This would be 1/6. So let's go ahead and put this at a 6. So we can start over here. Sorry about that. We need to round up. So this would be 5. You're still borrowing. So this would be 4. Supposed to be a period. And this would be That would be now 7 minus this is 4. So $48.45 is what you're paying the firm. So firm costs, and they call that, instead of calling it a firm cost, they call it a fund fee. And a lot of people who invest say that's why they can't stand doing some of these instruments, because you have to pay the firm. Now, it works out if you were actually making money, which this was at one time, but this and another. So if not, may not be the best investment. But that's what this analysis is about. So when we turn to the next one, this is yet another one, and we look at the total cost basis. This is actually given to you in your analysis sheet. So your sum of prices paid is $3,763.86. Over this cost is given to you $1,397. That's $269.42. Okay. I had a loss over here of 2.664. Really rounded would be about $6. Okay. And then over here, you had again, this is current cost, or current number of investments. Current cost per investment. People sometimes say this is dollar per dollar value, but they call it dollar cost averaging, and that's what you want to look at it. So if it's really 269.42, and remember, this is the same thing for a separate firm. It's actually a separate fund. I'm going to round this to 62 down. 0. It's an awful 0. 0. 8. So actually, it's only, fund fee is only $18.80. Okay, a little bit less. I put up here current cost, current shares. That's what this should say. I'm sorry, I was going to say, this is current shares. It's current number you hold. That's not bad. If 250 or 251 rounded up is not so bad, if you're going to, if this price here goes up. Okay, because then hopefully if it goes up to like 14 and we assume it's the same cost, hopefully we can get like closer, we might go down in total price and we'll have more shares, or maybe this price will go down and then maybe it will cost us less. But ultimately, one of the things we do want to pay attention to when you have a negative here, this is a loss. So that's how much this is how much has been lost within a year. Is it significant? It is if this keeps going down. But if not, and this is the current value, it's kind of not such a bad loss. And when you think about that, if you look at $262.64 over what you already have, it isn't so bad for being tied to an industry, tied to a market. And, you know, it really is only almost 7.5%, 8% of a down with this here. You're not getting 7% at the banks. So, or most of them aren't, unless you have like a couple $100,000 in the bank, or you have jumbo accounts. So jumbos are usually 50,000 or 100,000 in the bank or more. So it's not so bad for the little bit of money it is. Now, what is hopeful is what you'd really like to do is see this amount go up, the current value. Okay, And if the current value goes up, this price has to go up and then you have less shares. Okay, or this is another thing. And that's kind of why I know some people have been in the financial industry for a long time. They don't deal with mutual funds because of these kind of risks. They instead put a lot of their money into universal index life insurance, or they put it into this for later values. But what this person's hoping to do is hope that this overall value will go up, and that this number will stay here the same. And a lot of people assume that if this number goes up to $15, that you make money on that spread, and you do when it goes up and you don't buy anything. Okay? And so then you're going to make $15 minus about a couple of cents per share. And that's when this over here, your unrealized loss should start going down. So if you did $15 minus 13.97, you'd be at 103. So if you have 15 minus 13.97 and you're at 103, it's $1.03 gain per current number of investment units is what I call them. So that wouldn't be so bad if that happens. This has not happened yet. Okay, this is just a hypothetical. And then you have a higher price. Maybe they do dollar cost averaging, you have less units. But then, like, let's say your unit value goes down to 247 units, you'd still have a dollar increase on this amount. So this is when you'd start to see this go down, because then what would happen is 262, 64. Again, this is a hypothetical. This has not happened, and who knows if it's going to. You have a really, this is actually a global stock, and those stocks tend to be, they're good when they're good. You see what I mean? But they tend to be volatile, and right now there's so much going on in the world. And then you're in tsunami, hurricane season, which might halt some of the drilling. And this portfolio, this side of the portfolio was invested in those heavily. So that would be like an $8 gain, which is taking this up. So if this keeps going on, this is going to turn into what? Instead of being negative $8.23, it's going to go down eventually, hopefully, to back where you saw that 3-year gain of 0. And then if you wait, hopefully, another 3 years, you might see it going back up at $2. So the person who owns the stock is thinking at $2 per share at this amount. So then let's say you went down to 240 units, because while it costs more, it's split yet less. You would still be then up to, at $2, you go to $480 of a gain. But you might have to wait for 2 years. That's why I shouldn't put this other one in, because then it looks like I'm trying to say 4,000 and I'm not. Okay, because then what happens is you'd have $480 in gains. And then people say, I don't want gains because I don't want to pay capital tax, loss or gain tax. Well, if you have a tax attorney or you have someone at one of the tax agencies, they'll help you to get around some of that. So, or they can, teach you ways. Maybe you can donate enough so it doesn't, so that's another reason. So this is what we're hoping for. But this may take how many years? 3 years. So if you don't have 3 years to wait, then you shouldn't do this, even if it's that low. Anyway, if you have any questions, we're at jacobitslearning@gmail.com. Thank you so much for watching the video.